we've seen a huge increase in silver shorts, commodity shorts, which is generally a contraindicator. But we've got some negatives on the fundamental side, and that would just include a slowdown in China that seems to be happening. It does appear, though, I mean, and Jeff might roll his eyebrows, I don't know, if I say that it does appear that 33 is like a floor now. I think we've established a new floor. So I'm not, I don't see gold, I don't see silver collapsing from, I'm not sure that it's going to move much higher in the immediate term. I think the big move is still ahead of us.
While silver remains below its all-time highs, a monthly close above $34.60 would mark the strongest finish since August 2011, nearly 14 years ago. Such a breakout would likely draw renewed interest from institutional investors, hedge funds, and family offices, whose capital inflows are essential for driving the next leg higher. Adrian Day, founder and president of Adrian Day Asset Management, notes that $33 now appears to be a solid floor for silver. While he doesn't expect a sharp price surge in the immediate term, he believes the major rally is still ahead. The metal's volatile nature is reflected in its historical chart patterns. Despite intraday highs near $50, silver's highest ever quarterly close was $37.64 on March 31, 2011, putting a new record well within reach if momentum continues. Silver's movement has also been helped by the weakening US dollar, prompting a broader risk-on sentiment. However, silver is not just a safe haven asset, it is also a critical industrial metal, making it sensitive to both macroeconomic trends and global demand. This dual identity was on display when silver prices dipped following reports of a ceasefire agreement between Israel and Iran, dampening the geopolitical risk premium. Yet structural factors continue to support the market. Approximately 75% of the silver supply comes as a byproduct of mining other metals, such as zinc and lead. This means silver output doesn't respond quickly to price changes, keeping supply relatively inflexible. With a projected deficit of 117.7 million ounces in 2025, the silver market is heading into its fifth consecutive year of shortfall. This persistent imbalance is reshaping the landscape for both investors and industrial users, offering substantial upside potential while increasing volatility. In this environment, silver's role as both a monetary and industrial asset is becoming increasingly prominent, and long-term investors are closely watching for the next breakout. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Yeah, well, I certainly agree that, the best is ahead for silver. No question about, no question about that in my mind. I'm just not sure that we're at that point yet, to be honest. We've seen a good move. I'm not a technical analyst. We've seen a good move. Momentum seems to be slowing a little bit. On the positive side, we've seen a huge increase in silver shorts, commodity shorts, which is generally a contraindicator. But we've got some negatives on the fundamental side, and that would just include a slowdown in China that seems to be happening. Jeff might roll his eyebrows, I don't know. If I say that it does appear that 33 is like a floor now, I think we've established a new floor. So I don't see silver collapsing from there, but I'm not sure that it's going to move much higher in the immediate term. I think the big move is still ahead of us. Generally, I would agree with what Jeff said on the silver stocks. I think it's a time not to chase them, but to look for dips and so on. You mentioned, Jesse, that there are far fewer silver. You said you used the word pure silver mining companies, miners or exploration, than there are gold, obviously. And in the gold space, as an investor, there's 3,000 gold stocks around the world. I can pick and choose management, size, jurisdiction, etc. You don't have that luxury in the silver market. It's difficult to pick a silver stock and be very picky about jurisdiction because you just don't find big silver deposits in many countries around the world. One thing I want to focus on, if I may, is everybody knows the silver demand is different from gold demand, meaning there's a lot more industrial demand. I think it's been increasingly widely recognized that the supply side is also different. The silver supply side is different from gold, but it's also different from what it was a quarter of a century ago. You know, traditionally, and even up until, as I say, 25 years ago, something like 78 to 80% of silver came from production, came from primary silver mines. You also had some silver stockpiles, by the way. Today, you have virtually no silver stockpiles, although at a certain price, it'll always come out of the woodwork. But perhaps more importantly, most silver production now is byproduct. Something like 75%, so it's completely flipped. 75% of silver production is byproduct. Now, some of that is byproduct of gold, but a lot of it is byproduct of zinc or lead. And so the lead miner in Bolivia or the zinc miner in Peru does not increase his zinc production or open a new zinc mine just because the price of silver has changed. So silver production does not change very much. It's not responsive to changes in the price, up or down. And that's one of the reasons why silver prices, Jeff used the word spiky, move so much more. They're much more volatile than gold because the production does not respond to changes in price. And also focusing on the fact that there are pretty few silver names out there, what you find is that companies like, let's just say Pan American Silver, which is what, the second largest silver producer, I think, or one of the largest silver producers around, it produces, last year it had 18% of its production was from silver. So gold was over 50% and the rest was base metals. Even with the MAG acquisition, it moves to 22%. And yet because it's Pan American Silver, it will move when the silver price moves because investors are looking for silver stocks. Even Fortuna, which has changed its name from Fortuna Silver to Fortuna Mining, because for that very reason, they produce much more gold now than they do silver. But even Fortuna responds when the price of silver moves. So I agree with what you said. I agree with what Jeff said. When silver really moves, investors are going to start looking for a relatively small number of names, and they're going to have outsized returns.
Gold is facing renewed pressure as geopolitical tensions between Israel and Iran ease, with the possibility of a ceasefire, which undermines its traditional role as a safe haven asset. At the same time, the Federal Reserve's neutral monetary stance continues to offer little support for the metal, leaving investors cautious in the short term. Spot gold fell nearly 2% on the day, last trading at $3,306.19 an ounce. Selling pressure has been evident since the start of the week, with prices slipping further following the release of Federal Reserve Chair Jerome Powell's remarks. According to market analysts, $3,300 represents a critical support level. A decisive break below this threshold could open the door to a further decline toward $3,000. However, Adrian Day believes the bigger picture favors gold. He argues that while temporary geopolitical events may trigger price spikes, it is broader macroeconomic shifts that drive long-term gains. With signs of economic slowdown, a weakening dollar, and persistent inflation uncertainty, gold may be poised for a sustained rally. These structural dynamics, unlike fleeting headlines, offer the kind of support that could fuel the next significant move in the gold market. Let's get back to the interview.
Well, I don't know if it's a perfect storm. I would say that the traditional factors that have made investors, particularly Western investors, buy gold as an investment, we're not talking insurance or security here, but the traditional factors, which are mostly economic factors, are turning in gold's favor. So if you look at the last couple of years, everybody's asking why gold is running, but Western investors, North American investors aren't buying. And it wasn't totally illogical because the people that were the forces that were driving gold over the last 3 years and the reasons that those people were buying gold had nothing to do with macroeconomic factors in the West. So the narrative was a strong economy, high interest rates, low and declining inflation, reasonably strong dollar. That's precisely the wrong environment to be buying gold. But those factors are turning, and we don't need to go too much into it, but it's fairly obvious to me that the economy is showing signs of slowing. The dollar, as you mentioned, is showing signs of weakness. Geopolitical factors have always generally have been very short-lived. That's not what drives gold on a longer term basis. You only have to look. I mean, I've done a study on this going back to the Iran hostage situation. Funny, it's Iran again, but the Iran hostage situation in 1980. And typically, geopolitical events have short-term spikes. We saw this very clearly with the Russian invasion of Ukraine, where gold was moving up in the 6 weeks ahead of the troops moving over the border on anticipation of that happening. And within 6 weeks, it was just back to where it was. Obviously, if the market believes that a situation could continue to worsen, and there is that concern about the Iran situation, gold will tend to hold up. But you only have to look at the last few days. Gold has not built on that initial surge. So it's the economic factors that are most important in my view. And yes, they are turning significantly. As we know, in the last couple of years, the gold stocks, although they moved up, did not exhibit the traditional leverage that we associate with the gold stocks over bullion itself, nor the silver stocks over silver. But again, there were logical reasons for that. The people driving the price of gold, the central banks of the world, Chinese, non-official Chinese investors who were buying gold, and frankly, just wealthy individuals and families concerned about the fiscal situation around the world, as well as other things, the massive debt. Those people wanted physical gold. The central bank of Uzbekistan doesn't go and buy Newmont mining. And so that's why the miners kind of didn't exhibit that leverage. We're seeing it this year, as you mentioned, both of the GDX and the GDXJ are more or less double the performance of bullion this year, and the silver stocks are outperforming silver. And that, again, in my view, is a reflection of the fact that North American investors, whether they're retail investors, family offices, hedge funds, whatever, North American investors are finally turning towards gold, the gold space, which means they're buying silver, they're buying gold stocks, and I think it's just beginning. You look at the inflows into the GDX this year, it's still massive outflows, over $3 billion or nearly $3 billion right now of outflows this year. It's only been in the last month, but we've started to see meaningful inflows into the GDX, and the GDXJ has only seen a few days of net inflows this year. This might just, I'll close on this, but this might astonish you. I think the bull market in gold stocks has only just begun. To use a cricket analogy, maybe the third batsman has just come in. That's like the second innings in baseball, I think. Yeah, we're buying across the spectrum. I mean, I look at it a little differently from Jeff. We're buying across the spectrum right now. I mean, typically, as we know, the junior stocks will move after the seniors, and then the exploration will move, after the intermediate companies. But right now, even the largest companies that have had, and the best that have had the biggest moves, are still undervalued on a value basis. Forget price. Just look at value. You look at someone like Agnico Eagle selling in the lowest 20 percentile of its historic price to cash flow. And that's when gold is almost at new time highs. When margins, we typically get multiple expansion. You typically get higher multiples when the gold price is high. But Agnico, which is a top quality company, you can look at something like Barrick, which has jurisdictional risk, but that's selling in its lowest decile of its price to net asset in its entire history, which again doesn't make sense when the market is doing what it's doing. So we're buying across the spectrum. we're buying the large cap royalty companies as a foundation. Things like Franco and Wheaton, as well as Royal and the Cisco, are just great for a foundation of a portfolio. People think that they're overvalued. People think that they don't perform well in bull markets. They're right for bear markets, not for bull markets. I couldn't disagree with both. Yes, evaluations are not the kind of thing that will get Warren Buffett or Ben Graham sort of excited. But the valuations of Franco and Wheaton today are no higher. The valuations are no higher than they have been historically. We're buying the best of what I regard as the best of the miners, things like Agnico. And I agree with Jeff completely, although again, we're focusing on different areas, but I agree with him completely about looking at companies as companies, because the gold sector, gold and silver stocks, it's one of the most idiosyncratic sectors out there. And that's true of the seniors, and it's even more true of the juniors. A rising tide doesn't necessarily rise all boats. I mean, last week, I just looked at 10 stocks from the XAU at random. I picked them at random. And 3 of those 10 were actually down over the last 12 months. And whereas 2 of the 10 that I picked at random had gone up well over double. I mean, well over 130, 150%. And so they're very, very disparate returns that you get, even on the big cap stocks. And then, of course, when you go further down the food chain, those differences are much more. So for me, again, we're buying across the spectrum. You know, I've mentioned Agnico and Franco. If you don't own them, I would still buy them. And then as we go further down the food chain.
Despite the Federal Reserve's current neutral stance, some analysts believe it's only a matter of time before interest rates are lowered, a move that would likely provide further support for gold prices through the summer. According to the CME FedWatch tool, market participants widely expect the central bank to begin easing in September, which could serve as a tailwind for both gold and silver. This outlook extends across both metals, with one likely to lead the other, but both positioned to benefit in a rate-cutting environment. Even if silver were to break below the $35.48 level, the 50-day exponential moving average could serve as a strong support zone, likely attracting renewed buying interest. In the current macro setup, there appears to be little incentive to short the precious metals market, particularly with monetary easing on the horizon and geopolitical uncertainty still looming in the background. Momentum may be building quietly beneath the surface of the precious metals market. While headlines shift with each geopolitical tremor or central bank statement, the real story may lie in tightening physical supply and persistent macroeconomic drift. Silver, in particular, appears to be straddling 2 worlds, sought after both for its monetary legacy and its growing role in industrial transformation. If investor appetite continues to swell alongside these long-term drivers, the stage may be set for a historic move. Could the combination of constrained supply and macro tailwinds finally push silver into uncharted territory, and will gold follow or be left behind in its wake? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.